Welcome to part 2 of our short-run macroeconomic model. We're discussing the origins of interest rates. The Federal Reserve, the United States Central Bank, influences the interest rates, but they don't control all of them. Let's talk about the difference. The central bank sets monetary policy. This means that they set the federal funds rate. They only control one interest rate. This video is going to link that interest rate with the interest rates found in the entire economy. We're going to split up interest rates into two components: the risk-free component and the risk premium. As you would guess, the higher the risk, the more you'll need to be compensated. So the Federal Reserve targets this FFR, this federal funds rate. It's generally considered a zero-risk interest rate. What kind of financial vehicle are these quote-unquote federal funds? Number one, they're loans. They're overnight loans. So that's about as risk-free as you can think. You only have to risk it from dusk till dawn. They're probably going to pay you back tomorrow. The next bit is confusing because it has the word federal in it, but these are actually private funds. It's the funds between banks overnight. So at the end of the day, some of these banks don't have enough reserves. They need to get enough cash into their accounts to stay stable. And at the end of the day, some other banks might have more reserves than they need. And so they lend them out, others receive them, and then the next day they just pay it back. Consumers don't participate in this market, only institutional banks, who are some of the least risky members of the financial community. They're well established, they've been around a long time, they have high quality reputations, so there's practically zero risk lending to each other overnight. This is the interest rate the central bank targets. Well, how do we get to all the other interest rates in the economy? Take into account the risk premium. When there's a higher risk, a loan requires more compensation, a higher interest rate. Risk comes from a lower likelihood of repayment. This can happen when there's a longer duration. You have to wait more before that money gets paid back. Every time we have to wait, the higher the risk it doesn't get paid back. Also, the higher the opportunity cost of having that money lent out. Another factor is the quality or existence of collateral. Collateral is a different asset that is part of the contract to compensate in case of a loan default. So if I stop making payments on my mortgage, the collateral to the mortgage is the house and the land. This lowers the risk that the bank faces. It isn't risk-free because the quality of the house could deteriorate, or there's risks in the real estate market, as we saw drastically in 2008 and 9. But a lower risk will mean a lower interest rate. So from the borrower's perspective, putting up collateral means that they can get access to a lower interest loan. So therefore, the real interest rate in the economy will be the risk-free interest rate plus the risk premium. Enter our third curve, the monetary policy curve, or the MP curve. But before we draw the curve, I need to ask a question. In a previous video, we already learned where interest rates come from. It was from a different model, the supply and demand of loanable funds. The axes there were the real interest rate, but the horizontal axis was the quantity of loanable funds. We're in a different space here. And we've learned that real interest rates do affect aggregate spending, aggregate expenditures, consumption, investment, government expenditures, and net exports, or real GDP. And if we learned that the Fed can kind of just go in and set the risk-free interest rate, and that the rest of the interest rates are just going to be a risk premium, this has nothing to do with the output gap. And that's the key word. If a phenomena has nothing to do with one of the axes, it's going to be the same no matter what, then we need a flat line. And we get that with the monetary policy curve. The interest rate is composed of the risk premium, in this case the risk premium is 2%, as well as the risk-free interest rate, which in this case is 3%. 3 plus 2 equals 5. The Fed, just through their tools of monetary policy, they set the federal funds rate at 3%. And then the rest of the economy, taking into account the risk premium and the supply and demand of loanable funds, gets us that extra 2% for an economy-wide real interest rate of 5%. And that's it. That's how it's determined. Therefore, the MP monetary policy curve is flat. Now, we want to put this together with the IS curve, the investment savings curve, which will create a causal link from real interest rates to aggregate spending, to GDP, to the output gap, which in this case is in a recession at negative 2%. We don't like that. We want more economic activity. How can we incentivize folks to spend more? Make it cheaper for them to do so by lowering the most important price in the market, the interest rate. Here the Federal Reserve comes in. They lower that risk-free premium. They lower the federal funds rate. That MP curve shifts down. That lower interest rate will cause more consumption, more investment. We might see more government expenditures, and it will see more net exports. Altogether, more spending, Businesses respond by more production. Real GDP is higher. We are back at potential. The recession is solved. Our two curves, the IS, investment savings, and the MP, the monetary policy curve, the IS-MP graph, can help explain business cycles. When that output gap closes, we start approaching full employment. We're in a boom. Life is good. When that output gap grows, so does unemployment. We're in a bust. Life is bad. And the real interest rate, as influenced by the Federal Reserve, is a tool we can use to help address this. This is a graph of the federal funds rate. During a recession, as we can see in the gray bars, the Federal Reserve lowers the interest rate. We can see the interest rate came down in the early 90s. We can see it came down during the dot-com bubble of 2009, dropping all the way down to 1% by November 2003. And then during the financial crisis, it plummeted down to 0 and stayed at 0 all the way through 2015, basically. During COVID, it dropped again and has been rising since. But what does this do to the other interest rates? Here we're going to add in mortgages. And as we can see, the 30-year mortgage is a higher rate than the overnight interbank private loan. We can zoom in since the 1980s, and we can see that mortgages do go up and down in relation to that risk-free interest rate. For fun, let's add in credit cards. Credit cards are far more risky than mortgages. Mortgages come with a decent amount of collateral. Even though they're very long-term, the hefty collateral really mitigates the risk for a bank for a mortgage, whereas credit card debt does not come with collateral. The bank cannot seize those French fries you bought with McDonald's with that credit card. And we can see in the most recent years, the rise in interest rates in the economy we've seen to fight inflation has caused credit card interest rates to rise to the highest level that we've seen in decades. I'll add in one more. In purple, we have the 10-year Treasury security. We can see it has a lower interest rate than mortgages. Why would we expect this? Number one, the borrower is the federal government. The creditworthiness of the United States federal government is considered to be one of the best in the world. It'll be better on average compared to a mortgage. And the maturity is lower, 10 years versus 30 years. Both of those reasons mean that the risk premium for the Treasury security is lower than the risk premium for a mortgage. However, it is higher than the federal funds rate, the FFR, largely because the duration is so much more. Rather than an overnight loan, you have a 10-year loan. We've built quite a bit of the model so far. In the next video, we're going to do a lot of practice with this. We're going to shock the economy in a lot of different ways. We're going to have so many different kinds of recessions, and then we're going to talk about how we can fix it.